Welcome back to the channel, traders. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called Wedge Convergence Breakout. This one is built around a classic chart pattern that many compression strategies overlook, the wedge. Instead of watching an oscillator, this approach fits two trend lines directly onto the price, measures how they pinch together, and waits for a decisive escape. Over the next few minutes, we'll unpack how the strategy detects a wedge, how it decides between a long and a short, and how it manages risk with volatility-based stops. Remember, this is educational content only, so let's dig in. Let's start with the big picture. Wedge Convergence Breakout is a pure chart pattern expert advisor. Rather than relying on a momentum indicator, it reads the shape of the market directly by fitting two straight lines to price. One line is a least squares trend line through the recent bar highs, and the other runs through the recent bar lows. Together, those two lines describe a channel, and the strategy is looking for a very specific shape within that channel, a wedge. A wedge is different from an ordinary symmetric triangle. In a wedge, both boundary lines tilt the same direction while the channel narrows. That shared tilt is the whole idea. It encodes a move that is running out of fuel, because one side keeps pushing but each new leg gains less and less ground. Because of that exhaustion, a wedge tends to resolve against its own slope. A rising wedge, where both lines slope up and converge, is read as a setup for a downward break. A falling wedge, where both lines slope down and converge, is read as a setup for an upward break. The strategy runs on whatever time frame you attach it to, and it's often studied on liquid markets like the major currency pairs or gold on the 30-minute or 1-hour charts. It's designed for traders who prefer patient, structure-based setups rather than constant activity, because it only acts when a genuine wedge has formed and price actually escapes it. Two gates keep the strategy honest. The convergence gate confirms the channel is truly pinching together, not broadening out. The tilt gate confirms both lines share a direction and that the boundary has traveled a meaningful, volatility-scaled distance. On top of that, every decision is made on closed bars, so the signals do not repaint. This is a framework for understanding pattern-based automation, and, as always, it is educational information only and not financial advice. Now let's walk through the exact logic step by step. On each newly closed bar, the strategy takes the last 24 bars, that's the WedgeBars parameter, and fits two least squares trend lines. One line runs through the highs and becomes the resistance boundary. The other runs through the lows and becomes the support boundary. From those fits, the strategy reads the slope of each line and the width of the channel, both now and at the start of the window. Next comes the convergence gate. The strategy compares the channel width right now to the width 24 bars ago. The current width has to be at or below the convergence ratio, which defaults to 0.7 times the earlier width. In plain terms, the channel must have pinched into 70% or less of where it started. If the lines are spreading apart, that's a broadening formation, and the setup is rejected. Then the tilt gate confirms this is really a wedge and not a flat triangle. Both slopes must share the same sign, meaning both lines point up together or both point down together. On top of that, the average boundary must have traveled at least min-slope ATR worth of movement across the window, which defaults to 0.5 ATR. Scaling that threshold by the average true range keeps it meaningful on any symbol or time frame. With the wedge confirmed, the strategy classifies it. If both lines slope up, it's a rising wedge, and the bias is bearish. If both slope down, it's a falling wedge, and the bias is bullish. Now it waits for the escape. For a short, the just closed bar has to close below the fitted support line, while the prior bar was still on or above it. For a long, the just closed bar has to close above the fitted resistance line, while the prior bar was still on or below it. That two-bar condition is what defines the first decisive escape, filtering out aimless pokes. Risk management is entirely ATR-based, so it self-scales with volatility. On a short, the stop-loss sits 1.5 ATR above entry, and the take-profit sits 2.5 ATR below. On a long, those distances flip. Because the take-profit is a larger multiple than the stop, the reward distance is bigger than the risk distance on each trade. The expert advisor holds just one position per magic number at a time and lets that stop and target manage the exit. Trading always involves risk, and losses do occur. Let's read the actual MetaTrader code on screen. At the top are the inputs. WedgeBars, set to 24, is how many bars the two trend lines are fitted over. Convergence ratio, at 0.7, controls how much the channel must pinch in. Min slope ATR, at 0.5, sets the shared tilt requirement in ATR units. ATR period is 14, and the two ATR multipliers, 1.5 and 2.5, drive the stop loss and take profit distances. Lots and magic finish the list. Just below, you can see the two Boolean flags that classify the pattern. A rising wedge needs both slopes positive with enough upward travel, and a falling wedge needs both slopes negative with enough downward travel. Now look at the short block. The condition fires when we have a rising wedge. The prior close was at or above the support line, and the current close has dropped below it. When that's true, entry is taken at the bid. The stop is placed 1.5 ATR above entry. The take profit is 2.5 ATR below, and the trade.sell call sends the order. The long block mirrors it. It fires when we have a falling wedge. The prior close was at or below the resistance line, and the current close pushes above it. Entry is at the ask. The stop sits 1.5 ATR below, the target 2.5 ATR above, and trade.buy sends it. Both sides use the same volatility-scaled risk framework. Let's walk through this chart candle by candle and see both sides of the strategy in action. On the left, look at how price is drifting lower. The first several candles print lower highs and lower lows, but notice they're getting smaller and tighter as we go. The blue line above is the resistance trend line fitted through the highs, and the gold line below is the support trend line fitted through the lows. Both of them are sloping down together, and, crucially, they're pinching toward each other. That shared downward tilt, combined with the narrowing gap, is exactly what the strategy recognizes as a falling wedge. Watch the convergence tighten across the second, third, fourth, and fifth candles. The channel width has shrunk well past the 70% threshold, so the convergence gate is satisfied. Both slopes point down, and the boundary has traveled more than the minimum half ATR distance, so the tilt gate passes too. The strategy now has a confirmed falling wedge and a bullish bias, and it simply waits. Then comes the sixth candle. Price snaps upward and closes back above the falling resistance line, while the previous candle was still trapped underneath it. That is the decisive escape the strategy has been waiting for. You can see the buy entry marker fire right there. The moment that close clears the upper trend line, a long position opens. The stop loss is tucked 1.5 ATR below the entry, and the take profit is projected 2.5 ATR above, giving a reward distance larger than the risk. Now follow the next two candles. Price accelerates upward, exactly the kind of release you expect when a wedge resolves against its slope. By the eighth candle, price reaches the take profit target, and the long trade closes for a win in this illustration. That completes the buy side of the story. Now the character of the market changes. From the ninth candle onward, price starts grinding higher, printing higher highs and higher lows. Look again at the two trend lines. This time both the blue resistance and the gold support are sloping up together, and once more they're converging as the swings get smaller. This is the mirror image of before, a rising wedge, and it carries a bearish bias. The convergence gate confirms the pinch, and the tilt gate confirms both lines share an upward slope with enough travel. The strategy now waits for a break in the other direction. On the 14th candle, price drops and closes below the rising support line, while the prior candle was still sitting above it. The sell entry marker fires right there. A short position opens, with the stop loss 1.5 ATR above entry and the take profit 2.5 ATR below. Follow the final candle. Price slides lower after the break, and it reaches the take profit target, closing the short trade in this example. So across this single chart, you've seen the complete cycle, a falling wedge breaking up into a long, and a rising wedge breaking down into a short. Each one entered only on a decisive escaping close, and each one managed by volatility-based stops. Of course, not every wedge resolves this cleanly in live markets, and losing trades are a normal part of any approach. So there you have it, a full breakdown of the Wedge Convergence Breakout Expert Advisor. We covered how it fits two trend lines to recent highs and lows, how the convergence and tilt gates confirm a genuine wedge, and how it enters on the first decisive close that escapes the pattern against its own slope. We also walked through both a falling wedge long and a rising wedge short, and saw how the ATR-based stop and target manage each position. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like me to cover next, and subscribe for more MetaTrader 5 breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.